Welcome to the Raises.com Capital Raises show. Today I'm with David Weinstock. David had three multi-hyphenate careers before launching a real estate fund. David, nice to meet you.
It is a pleasure to meet you. Thank you for having me on. I appreciate it.
No worries, we're going to have some fun here. So the first question I like to ask is, everyone has a story. So when it comes to you launching your real estate fund, what's your story?
So I have an untraditional story in that I didn't start out in real estate. I didn't start out in private equity. That claim to fame of three different, hyphenated careers. I probably had more than that. I worked in lots of different industries, and I started my career as a computer geek. I was fixing computers in office parks and being dropped off my parents when I was 15 and 16 years old to kind of be tech support. And that actually played really well, and that started bringing up my career from the technology side. I worked as a consultant in my teenage years for a bunch of older guys, and we worked at a company that's no longer here, but a lot of people know, Polaroid. So I'm out of Boston, Massachusetts. Polaroid used to have their headquarters here. I went to every single Polaroid site and touched every single computer in every single location as a teenager, helping them put their first network in. So that was how my career started. And then I basically got involved in startup consulting companies, implementing customer relationship management systems. And I was really into the startup culture, really loved that environment. I joined a company that had 300 people at the time. They started getting big and went international, and the .com burst was going. And then I rapidly started jumping startup to startup to startup until it was me and three guys staring at each other in a conference room going, what did we do? From there, we built a consulting company, wound up being sold to private equity. It was my first taste of what private equity was. And then I went on to corporate America after that. But I can't sit still. And so in corporate America, I put myself out of a job every 2 years, and then they give me something else to do. So I got a chance to do a lot of different roles, and they'd give me a couple guys, we build a team out of it. And then once that was working here, take that back, do it, until at the end of the journey, the company was brought, it was a public company, was brought private. And I put myself out of a job, and they said, well, we can't invent a new job for you, but you can work at other places in the company. What do you want to do? And I remember this memory so vividly 7 years ago from today. I'm sitting with my wife, and I've got these different opportunities to one of 30 of these guys and one of 20 of these guys, and I didn't want to do any of it. And my wife kind of gave me the ultimatum. It's like, if not now, when? And she had met me when I was in the startups and doing all this stuff, and she thought I was just going to do another startup. So fast forward, I actually became a developer. I didn't know that's what I was going to become, but it happened because I locked up two projects. I'm in the Boston area. We do a lot of condo conversions here, 2, 3, 4 family buildings that you gut down to the studs and rebuild them. Except I had a little problem with our very first property, in that we got a contractor with a price that was too good to be true. We gave him a deposit. He didn't start. Comes back, oh, I need a little more money because it's a bigger job. And we gave him the deposit, and he didn't start. Started saying, hey, if you don't start, I need to get my money back. And lo and behold, he started. Gutted the entire building out. Everything's gone. And then a week later, I get a fine from the city and a stop work order for doing work without a permit. Call the contractor. He's nowhere to be found. Hire a lawyer. Finally track him down. Sued him. It's a long story, but bottom line is we wound up suing this guy. We got 70 cents every dollar back, and it forced me to partner with a builder. And in that process, I learned about everything about building a house. I worked with the planning boards, the building department, and I went everywhere with the builder. I came to the job site every day. So I became a developer. And then 2 units became 4 units, 4 units became 7 units. Then I'm doing subdivisions, value add real estate, start buying apartment complexes. And that kind of launched me into kind of where I'm at today, which is, grouping investors together, buying large commercial assets, et cetera, and then moving into the fund, which I'm actually in pre-launch right now. So whenever people see this, this is probably pre-launch to my fund, but we'll be going live this quarter. So that was a long-winded answer.
No, fantastic. I mean, it's important to go through the roller coaster ride, to become a fund manager, right? So, like, I'm thinking, like, when it comes to now that you're at the cusp of actually launching and managing this real estate fund, what or I guess even in investing, what do you think are some of the most common myths, misconceptions along the way, whether it be in real estate investing, real estate developments?
I think when I first saw people who were starting their own funds or were successful fund managers, they made it look so effortless, so easy, and they seemed so on top of things. And what I realized, just trying to get my fund off the ground, or even just doing some of the earlier investments, it's a lot of work. And it's not one particular place you focus. I mean, we know it's a lot of work. Everyone knows there's work to be had. But again, they make it look so easy. You see the social media posts, you see people out there, but you don't know how many hours goes into becoming really good at your craft and your trade, really establishing those deep relationships, whether it's with investors or with sponsors, or whether you're sponsoring your own deals. In my case, I started doing projects in the Atlanta market, but I've been traveling down there for 2-3 years, building my network and getting to know people. I was on a plane every 6 to 8 weeks because I thought it was important to have local boots on the ground. And so as I'm pivoting to start and launch this fund, we've been doing syndications and doing joint ventures before this. It's important to have trusted local partners to get the work done, because as good as I may be at learning pieces of how to build a building or do it, I have partners that have built 4,000 units or have been doing this for 20, 30, 40 years. That's a level of experience that I don't have the time to amass, and they're better at it than me. It plays to their strengths, and I need to play to mine. So that was one thing that, that first launch of that fund is really important to know how much work building that base is before the fund itself goes live. So the number of investor calls that I've already had, the number of sponsors that I've talked to, the pipeline that's already there. When we turn the fund on, we'll have multiple assets ready to go. We'll have multiple investors ready to go, which means we're off and running, where I think other people just say, hey, my doors are open. And then they have to say, all right, I've spent all this money and I put all this time, but I don't have a deal yet. How do I do it? And I don't have investors yet. How do I find them?
See, exactly. And when it comes to all the things that you've learned, I mean, because you went through the typical, evolution of, like, the consulting different companies, investing and working with syndicators, and now launching your own private equity fund. What would you say are some of the returns and the terms of the deal, in terms of what people are willing to expect, and what are some ways and tactics in making sure that you have your finger pulse, like, on the pulse of the market, so that you can offer terms that make sense for potential investors?
Yeah, no, we work really hard to make sure that the terms we're offering are going to be attractive to investors. We want to be different than everyone else. With my background as a developer, I've gotten really good about speaking the right language with that type of sponsor. And we tend to either co-GP and be partners with them, or be early on where they have something they're working on, but they haven't really decided if it's a project yet. So we get some really good early access to projects before they even kind of come on. A lot of off-market stuff, a lot of things that are through the network only. So that's one piece. And then the second is, obviously we have an investor community that likes, I call them, mid-tier deals. So most of our deals are probably below the $20 to $25 million range. So we might do anything as low as like 4 or 5 million and up into that range. And we can get slightly better returns than you might see on the larger institutional. So if larger institutional, and again, these are just example returns, this isn't actual returns. I'm not, we know that there's certain guidelines I can't, speak about here, and I want to make sure I'm not misrepresenting. But, talking to a lot of the institutional folks that I know, the returns are probably between 11 to 14%. Because we work on smaller deals with probably quicker turns, or doing a little, finding more of the diamond in the rough, and we spend a little more time cultivating them, we tend to do much better. And I'd say that our average returns are probably, north of 20%. But again, every deal is different, and everything is different within a fund and how we're targeting it. But we've been very fortunate so far.
Yeah, exactly. And obviously everything here is for informational purpose, but it's good to have a range. So when it comes to the types of investors whether it be their demographics, the check size. What are some of the patterns that you noticed, like throughout your career? Because we have our own observation, but I'm curious on yours in terms of, how big the check size is, where they're from. Are these investors that are more small limited partners that are already in many deals? Are they more novice accredited investors, or are they larger institutions that are putting capital into the deals throughout your both throughout the early career and in the last career? So I guess if I were to summarize that question, because it was a long-winded question, what demographics have you worked with in terms of investors in the past, and what are you looking to work with in the future?
Yeah, I think we're being pulled upstream based on just the demand of what the capital markets are today. But how we started and what we did, we tended to have more of a sophisticated plus investors. So we have folks that are, professionals in business roles for the most part, doctors, lawyers, accountants, tech professionals that have a little more sophistication. We really pride ourselves on educating our investors. We want an informed investor to be able to understand the deal terms, to ask the right questions and move through. And we've been very fortunate that because we have an educated investor base, we get a good check size on our initial, investments, and those grow over time as they get to know us. We've done a number of joint ventures with family offices or groups of people that have come together to pool capital. We haven't done a lot of institutional capital, but where we are right now is we're talking to a lot more family offices and larger high net worth individuals that are looking to write a single check or one or two checks on a deal. And, that's changed a little bit of what we hunt for and how we do it. But yeah, that's the range. But for the most part, we're not institutional guys. We're not looking for the pension funds. We're not looking for $60 million, acquisitions at this point in our trajectory. We might do a separate fund that does that in a couple of years, but I will also share that we are working regionally in a lifestyle. So we're not a national brand and don't expect to. We're predominantly, East Coast to the Southeast, and that's, where we like to be. Good relationships, good partnerships, people we've known for a while.
Got it. And so with that, could you speak to us more about the investment strategy? Like, would it be, and I think we were talking a bit offline, but would it be more, you have a background development, so like a 5-year term, and then it's like, you're buying and you're doing some value add to existing properties that are cash flowing in addition to some development. So I'm just curious on that in terms of
the investment strategy. I mean, a lot of people will tell you it's opportunistic. I mean, and it is. I mean, we look for good deals. If it's a good deal, we'll present it to our investors, and if it's a really good deal, it'll probably go in the fund. And we'll have a customizable fund, which that is really unique to begin with, in that it allows the investors to actually earmark specific assets within the fund that they want to deploy their capital to, versus just a blind fund. But we do a mix. So I think there's sometimes that we need some value add deals because they provide some cash flow as well as the upside, and some development deals as well, because they may not provide cash flow, but they provide a significantly higher return, on successful projects. And we would never put a development project into the fund or offer it to investors until after we've de-risked it. And just in case you're not familiar with the de-risking, concept, any type of land entitlement work, we found a piece of land, we found an existing building, we want to turn it into large apartment buildings or something like that. We're going to go through all the approval steps and processes so that by the time an investor is seeing it, it's to physically build it. There's nothing, nothing questionable. Could we build it? Is this approved? Is this something you can do? Because that's speculation. So we have a pot of money that we use purely for speculation, but we don't offer that to investors because we think there's too much downside risk. Because if it doesn't get approved, you may not get the upside. You may not have that full path to do it. I think so by bringing a opportunity that we've already de-risked, we already got it entitled, we've already gotten approved. That's just it's a different beast. Now it's just a question of, we think it's going to take 3 or 4 years to build this. We think it's going to be worth this in the end. We have all the market comps to say so, and we've got a great rock star team to build it. That's a great opportunity for some people. And so, we run the gamut, and that way we kind of have a more balanced portfolio.
I like it, and I totally agree, because when an investor doesn't have to take permitting risk, zoning risk, licensing risk, to prepare the land, then it usually, skips a lot of steps and a lot of uncertainty. So
Yeah, and let's be honest about the market that we're entering into right now. So there are times to build more and there's times to do more value add. And all has to do with what type of assets are in the market and what's the replacement cost of doing it. So we know historically it is really hard to build net new housing in the country in many areas. But there are certain metros in certain areas that have lowered the barriers and they're building a lot. So as the economy softens a little bit, I don't know if I want to be in the market where we're building a lot, and so that might be more of a value add play in those markets where you have an older asset, everyone's going for the shiny new object, but they're building 2,000 units at a clip. I'd be more than happy to take 100, 200 units that were built in 1980 and bring them up to snuff. I think that's probably a better play. Whereas if I'm in a denser metro with higher barriers to entry and we get something approved, any day, all day, because that before it even comes out of the ground, you've got people who want to put deposits on it. So I think the area really matters, but also where you are in the cycle.
Oh yeah, and it's funny. I was asking just about to go into that because it looks like you're already taking steps and some serious steps to just make sure that through this market cycle, we're recording end of January 2023 at the time of this video or this audio, depending on where you're hearing it. So I guess when it comes to that, like, have you noticed any difference in terms of the debt that you're going to leverage? Has there been a change in that? Are you changing the loan to value?
Yeah, I mean, so we're definitely able to go a little slower on our deals to put the right type of debt in place. I've got 2 deals going on right now in the Carolinas. One of them we've got bridge financing on it, and another we actually placed permanent debt on it now, even though we'll probably refinance in 2 to 3 years. But there was a 3-point difference between the bridge and the permanent debt without a prepay penalty. And so when you look at what's going on, there's more negotiations with the lenders today in terms of what they can bring to the deal. If you can't get on rate, I mean, just again, for historical context, rates today for long-term finance are around 6%. Bridge debt's probably 9% plus, maybe 10%, depending on who you're talking to. And so you have a huge range that's going on. But if you went back 6 months from now, rates were in the 3s. So we're talking about more than a doubling of where we started out. And so we are looking at what makes sense. We're getting longer, interest-only periods. We're negotiating with earnouts and doing loans that instead of doing a full refi, they're saying, well, if you're going to hit your NOI targets within a particular period of time, we're going to give you a little more juice along the way versus rewriting a new loan. And so I think the volume of loans has probably come down a bit, and they still need to do business. They still need to write them. So their hands are tied in some pieces, but they're more flexible in others. Also, although I have not seen a lot of this yet, anecdotally from other peers of mine that are buying and working in park buildings, they're seeing a lot more opportunities in the smaller mom and pop buildings, the less than 150 ones, that a component of seller financing may exist. So you're trying to maintain your price, but you're not going to get the full one finance, or you don't want to pay 10% to do it. And so you're getting more creative deals, or people want a little more rescue financing, because a lot of people on bridge debt without a cap on it and they're coming due are in trouble because the rates really ratcheted up on them.
Yeah, you can get really
those are good deals, good opportunities for deals.
Fantastic. I mean, it's nice to hear that at least you're seeing some lenders that are willing to accommodate later on, instead of it just being a crazy amount of refis in the middle of the next wave of the economy. So
yeah, I mean, these are cycles. I mean, I think the 3% world that we were living in was rare, and I think it is a more normal market for the long run at rates in the 6 and 7s. I don't think we're going to go back to the 80s when rates were 14, 15, 16% at different times. I think that's unhealthy. That's too high. But again, we've gone through so many strange events, leading up to where we are today, whether it was COVID or you name it. So just a lot going on.
Yeah, it's been a really weird because the pandemic and this huge bull market and everything. So yeah, and hey, this recession, we're talking to one of our CFAs, and then there's this softening of allegedly this softening of interest rates before the recession, and so how that may or may not shorten it. So so I don't know. There's a lot of chaos going on, but one thing is we're working with a lot of real estate syndicators who are currently in that either real estate investment or syndicating world that so far. I mean, you're already evolved to the like you're about to launch the real estate fund and you have evolved to this level. But for those who are currently self-invested in real estate using only their own capital and then maybe a hard money lender or lender, or maybe people that are just syndicating, I guess what is one key thing that you would advise them as they're going
Yeah.
through market cycles or just in general?
Yeah, I think it comes back to do as I say, not as I do. No, I mean, I think we're doing the right things. Two things. I mean, I think I'm going to flip the question a little bit, and whether it's this market cycle or a different market cycle, it's just a question of if they're in it for the long run. And so there's plenty of deals in every cycle, but you can't do thin deals. You have to really do your homework, make sure it makes sense, pressure test everything you're doing. And I think for folks that are starting out or using your own capital, you don't always spend enough due diligence time doing that. And for someone who's syndicating and taking investors' money, or for someone who's placing their own, as you scale, it becomes more important to make sure that you are stress testing things. So the cap rates of today will not be the cap rates of tomorrow. If you're not writing in a decompressed cap rate in your underwriting, you're probably missing the boat. If you expect that rents are going to go up indefinitely at 3, 4, 5% or higher a year, that doesn't always hold true, especially in a market that's softening. But I think there's a bigger piece here, and this is one where I wish I could learn from my future self. I already told you my story. I had an untraditional start into private equity, into real estate. I did have some early forays into real estate. I bought my first multifamily in my 20s, but then I didn't do much because I was doing all these startups for 10, 15 years. And it's only really when I went full time did I figure this out. But I worked by myself for the first couple of years, my own projects, my own capital, etc. So I was, the alpha version. I'm the one who made the mistakes, and I learned from them. But what I would do differently today is I would partner with people. This is a team sport. This is all about surrounding yourself with your tribe, surrounding yourself with people who uplift you and make you better and allow you to do more versus trying to go it on your own. And I think for every successful guru, fund manager, etc., there is a slew of people behind them and a huge support structure and network. I mean, look at your organization, raises.com, look at, the other groups that are out there. Like, this is not one person. They represent the collective knowledge of so many people. That's what I would do differently. I would partner up earlier. I'd be open to that. I would test, those early partnerships and doing more, because it's scary when you do it by yourself. But if you have experienced partners and you can kind of grow together, I think you just move so much faster. I can speak for myself that if I know what I knew today and partnered the way I did now, I'd be in a very different spot if I started this in my late 20s or early 30s.
Well, thanks for sharing this. You just shared a shortcut, a life shortcut, because we can't buy time, but we can only buy I guess this is even free. We can only get access the experience and lessons that other people have gone through. So the wisdom that you shared would definitely go far. And I guess more generally speaking, when it comes to the people on the buy side, just if we're to speak in generalities, what are some of the core problems that you can speak to in terms of, like, is it capital preservation that limited partners struggle with, based on your experience, or deals like the ones that you're working on, or is it capital appreciation? What are some of the core things that JV partners, limited partners, or investors really struggle with, and what type of solutions at its core does your deal really solve? for them?
Yeah, I think for my particular investors and the types of deals that I do, anything that's value add based is capital preservation first, and then looking for a return that beats the market. People who've got 401ks in their stock portfolios have gotten crushed in the last 18 months. And so unfortunately, if they're looking to retire in the next couple of years, they've got a long way to kind of dig this back out. The bull market's over, but real estate keeps producing. So it's a good alternative investment. So that's one group. And the second is, again, the development, which is a higher return. So I think, the problem that I solve is I've got, folks that were like me, folks that are working corporate jobs, et cetera, that just kept trading their time for money and wanted to start getting some flexibility as they got older and wanted some financial flexibility. That is my audience. I mean, those are the folks that this isn't Ferraris and private planes overnight, which some people may have a system or may have a path to it. There are solid ways to invest your capital to grow it over time that gives you an advantage to people who leave it in the market or people who don't invest in these types of assets. And so I'm the slow and steady, beating the market, and trying to do good by all. I mean, I really want to lift all boats. I mean, something that we haven't really talked about much, but the deal is the last in my priority of figuring out what I should do every day. People first, then where am I doing business, and then the project. So if I'm not keeping my investors happy and providing the returns that I think they deserve and that I've suggested we can obtain, that's someone I don't want to let down. And then when I find the deals, if I partner with someone, I want to be a great partner with them. I don't want this to be one deal we do together. I want to be planning the next 3, 4, 5, 10 years together. So it's those two pieces. I mean, I think that's the difference that I do. I'm very relationship driven. And so we're small, very personalized, and we just want to keep doing what we're doing.
Yeah, well, I can see that it works, and it's good to hear. So if you were to, because I guess we're winding down, because you've given a lot of great gold nuggets. So I mean, but if you were to look at either a mentor or a book, or if there is something that you could recommend in general to the audience who consist of both potential limited partners or other real estate investors, what would you recommend to them?
I don't want to be, like everybody else, but I have to start with the gold standard, which is I read Rich Dad, Poor Dad when I was a teenager. And the one nugget that really stuck with me is the people who are working every day are trading their time for money, but the wealthy invest their money to provide themselves time. Their money earns for them whether they're working or not. And I think that understanding that capital can grow if it's invested, again, it's not a novel idea, but when you see it on paper and someone reminds you that that's a big deal. I mean, I made my first half of my career based on trading all my time. I worked 60, 80-hour weeks. I was on planes and trains and automobiles. I had 1 year where I rented a couch because I wasn't home. People trade time thinking that if you just keep working harder, if you just get that next promotion, and we realize that the number one wealth builder is assets like real estate that compound and have all these other pieces. So I think Rich Dad, Poor Dad for that key piece is really, really important. There's 1,000 others on financial analysis and things like that I think are really helpful. But I think that's the number one to start with.
Awesome. Foundations first. And then, this has been a really, really good call. And I think as we wind down, what would be the main way that potential limited partners, business partners, or anyone who just wants to discuss and learn what you're working on, how could they get in touch with you?
Yeah, I think the best way is to visit our website, www.dwcapitalllc.com or investwithdw.com. Sign up for a newsletter. We have a bunch of educational content that comes out. Again, simple terms if you're just starting out: IRRs, equity multiples, why does leverage work, all the fun things, as well as, monthly newsletters. And then if it's people who want a little more, we love to have one-on-one calls. My personal contact information is on the website too. And, I think that's the best way to get in touch.
Awesome. And David, I think through this call, we've touched on a lot of golden nuggets, but just in case we didn't miss anything, is there any last remarks that you want to share with the audience before we call it a close for today?
This is obtainable to everybody. I'm flattered to be on here, Natu. I really enjoyed our conversation. I think I've said what I can say for here, and this has been a great experience. Thank you.
Awesome, no worries. There you have it. That was David, everyone. Thank you for watching this show, and we'll have all of the contact information in the show notes. See you next time.